Good day, ladies and gentlemen, and welcome to our 30 June 2021 multi-asset quarterly update, where we look at some of the key return drivers in our multi-asset strategies and also some interesting aspects from the markets over the last quarter and over recent history. Q2 in summary, in the global front, we see COVID continuing to ramp up to 180 million cases from 85 million at the beginning of 2021, so more than doubling in the last 6 months. However, on the positive side, developed markets have executed really speedy and impressive COVID-19 vaccine rollouts. However, their emerging market counterparts have struggled to achieve the same kind of efficiency and impact in rollout strategies. Globally, we see rates remaining low, with the Fed giving indication that they only expect to raise rates in 2023. So we still sit in this low for longer rates as relates to nominal interest rates. However, what is coming in as a major risk in global financial markets is the risk of inflation and how portfolios are positioned to deal with global inflation. And indeed, we did see an inflationary shock to the upside in the US coming in Q2 of 2021. So it remains a hot topic in global investments landscape is what is the impact of an inflationary environment going forward. Notwithstanding some of the inflationary risks that sit in our system, markets do continue to rally. Most equity markets, most significant equity markets, US markets, etc., continue to hit all-time highs. So really the optimism flowing into global markets. And certainly in the last quarter and the last 6 months, we've seen that optimism creep into a real risk-on environment where emerging markets and emerging market currencies and equity markets have benefited from flow of capital from developed into emerging markets. In our local market, we see COVID cases exceeding 2 million from 1 million in the beginning of 2021, so just about doubling in the last 6 months. Our vaccine rollout has come in fits and starts. There have been areas of excellence and areas of disappointment. So we're still a long way from effecting a thorough rollout of vaccines. On the interest rate front, our repo remains unchanged over the last quarter at 3.5%. So repo has been stable for some time now. And remembering that globally, SA interest rates are still looking attractive. Not dissimilar to the global side, we saw an inflationary shock to the upside in the last quarter, with headline CPI hitting 5.16%. But some of the rapid shifts in CPI was primarily due to a low base effect of a year ago CPI sitting at below the lower band of 3 to 6% in terms of the mandate of the South African Reserve Bank. We've also seen the ZAR strengthen relative to the USD over the quarter, and in fact over the last year also the rand has been one of the strongest global currencies relative to the dollar, and it has continued this over the last quarter. The local economy did come under further restrictions, liquor ban, prohibition of liquor into the last quarter, and certainly a ramp up in lockdown restrictions in terms of travel and other activities. So the local economy did close down. We hope to see an opening up as COVID cases reduce into Q3. Looking at our local local market, and then again into our wealth accumulation fund at a quarter to date and a year to date basis, really is a story of growth assets, local equities and local property driving the majority of returns on both a quarter to date and year to date basis, where at an attribution level and at an absolute level, the standout winners came from risky assets. Locally and globally, some of the returns were muted as a function of a strong rand. So a lot of the global equity upside in the last quarter has been muted by a relatively strong rand. If we decompose some of the returns, what we do see is that notwithstanding the standout performance from property at an attribution level, it has a relatively small return driving aspect within the context of local equity as a function of its relatively low weight at 7.5%. Local equities really driving the majority of the 10.14% year-to-date returns, that relative to 9.2% in the peer group, and 3% quarter to date return relative to the 1.84% return from the CISA peer group. If we look at the stable income fund, we see a similar story. Growth assets really driving performance on a year-to-date basis. However, if we look at quarter to date, local bonds having a large contribution to return, a significant weight in the portfolio. So, if one considers the total bond bucket of local nominal bonds, local inflation linkers, and local credits, that combination was a large return driver over the quarter. However, if we look further afield to the year-to-date contribution to return, our risky assets, equity and property, were the major drivers of return, closely followed by global equity. Again, global equity returns muted slightly by the rand strength in the portfolio. Total return year-to-date is a pleasing 7% relative to the peer group average of 5.29%. On a quarter-to-date basis, 2.8%. Relative to a 2.43% peer group average within the strategies. An interesting takeout from the last year certainly has been that SA equities have been the place to be. If we look at a set of global equity markets, the major global equity markets, South African equities continue to lead the way, notwithstanding a fairly muted last quarter of returns. All of these returns converted back into the same currency, so comparable. And the second best returning equity over the strategy being Indian equity markets, the Nifty 50 index. So really emerging markets equities have been the return drivers over the last year or so, notwithstanding some of the base effects and currency movements. So fortunately, as a function of both of our regulatory constraints, we hold a large proportion of SA equities, and SA equities have been great return drivers in the last year, and certainly in the last 6 months or so. We wanted to, as per usual, look at something from a portfolio construction perspective, just a 2-minute kind of takeout as to the importance of time horizon. And to show this importance, we've looked at what we call the crocodile jaws. Crocodile jaws looks at a stress test where we ran Monte Carlo simulations. So we ran 10,000 simulations with different asset allocations. So looking at the low equity category, if we took the most conservative low equity portfolio and the most aggressive low equity portfolio over a 1-year time horizon, we can see the potential range for outcomes on a 5th and 95th percentile, from the more conservative to the more aggressive. And one would probably be considering within low equity, you don't really want downside. But remember, of course, well, first of all, these are real returns, and this portfolio is designed to be invested over a 3-year time horizon, and you see these crocodile jaws close down. So it's really important to have the appropriate time horizon and the appropriate investment, and you can see how those range of outcomes, the probability of that range of outcomes really does tighten up if you start looking at an appropriate time horizon. Same can be said in terms of having an appropriate mix of growth assets. One could ask, why would you risk this 6% real downside over 1 year relative to 3%? You're not really interested in all this upside. Well, if we look at the probability of achieving CPI plus 3 over our 3-year rolling time horizon, what we can see is that as we lever in more and more growth assets, as we take a more and more aggressive low equity portfolio, we have a higher probability of achieving our particular outcome. Again, this is a stress test looking at a Monte Carlo simulation. And again, contrasting this with a CISA peer group, whom over the last 15 years has only achieved CPI plus 3 35.8% of the time. Same example, we have a look at our high equity fund, typically a CPI plus 5 over 5-year category. Over the 1-year period, you can see a very wide range of outcomes from -8 on a conservative high equity portfolio to -11 to up to 31% over a 1-year time horizon. Look at the appropriate time horizon, and that range of outcome really tightens up, and importantly, it tightens up and skews to the upside. So again, this really does highlight the importance of appropriate time horizon when making your investments and when putting clients into portfolios. And again, just having a look at the importance of this growth lever, looking at how by including more and more growth assets, both local and global, one can really increase the chance of achieving your clients' goals. Again, a CISA peer group average looking at 28.9% of the time, achieving CPI plus 5 over the last 15 years. So thank you for your time. We hope that was useful. As per usual, if you've got any questions, please don't hesitate to give any one of us a shout. And we hope to stay in touch and catch up in the near future. Thank you.